Hello everyone, welcome back to Investment Research. I'm Simo, your equity research analyst, and today I'm giving you a numbers first institutional analysis for those two small cap stocks. I am actively watching and rate a strong buy for a speculative sleeve, Anteris Technologies, ticker AVR, and Achieve Life Sciences, ticker ACHV. I will give you the facts that matter, the financial context, a valuation frame, explicit price targets under bull, base and bear scenarios, probabilities and expected timing, and a tactical trade plan you can follow. I will also be very clear about the risks and what will make me change my mind. Let's start with a short orienting snapshot for each name and then go into the analytic meat. Anteris Technologies snapshot and what to know right now. Anteris trades around $4.40 today with a market capitalization in the roughly $150 to $180 million range. The company is pre-commercial on its DurAVR transcatheter aortic valve and has just announced binding commitments for a private placement of approximately 38.5 million Australian dollars to fund the pivotal Paradigm trial and to accelerate manufacturing scale up. As of June 30th, the company held roughly $28 million of cash on hand. That placement materially extends runway versus the June balance, but the company will still need to manage enrollment cadence and manufacturing milestones carefully to avoid near-term dilution if enrollment or regulatory timelines slip. The core value driver is the Paradigm registrational program. If DurAVR shows persistent favorable hemodynamics, strong safety, and no durability flags, the device can command premium pricing in a multi-billion-dollar aortic valve market. Practically then, this is a classic clinical milestone story where the equity acts like an option on regulatory and commercial success. Now the numbers investors must focus on for Anteris. Current share price around $4.40 implies a market cap of roughly $160 to $180 million depending on intraday moves. Cash on hand was 28 million at June 30th, and the recent 38.5 million Australian dollar placement equals about 25 million US dollars of additional cash. So pro forma cash is in the mid $40 to low $50 million range after the placement proceeds settle and transaction fees are paid. Quarterly burn, including R&D and trial spend, has been high as expected for a device company in registrational testing, so that runway extension is meaningful but not infinite. Volume is thin relative to large caps, so price moves can be amplified by news flow or block trades. Valuation and scenario framework for Anteris. Because this is pre-revenue on a prospective medical device, traditional multiples are not meaningful. Instead, I use a scenario-driven valuation using market cap outcomes tied to clinical commercialization assumptions. Under a bear scenario where Paradigm stalls, manufacturing issues arise, or further dilutive capital is required at materially lower prices, the reasonable range for the next 12 months is down to 50 cents to $3 per share, representing a market cap as low as 20 to 70 million. Under a base case where Paradigm completes enrollment on schedule, 1 or 2 regional pilots are established, and there is at least one OEM or distribution partnership announced, the company could re-rate to a mid-microcap valuation of $400 to $750 million. That implies a share price in the mid-single digits to low double digits depending on fully diluted share count after the placement, so a base case 12-month target near $8 to $10 per share is sensible. Under a bull case where Paradigm shows outstanding durability signals early, a strategic partner is announced and a clear pathway to limited early commercial revenue appears, a re-rating to $1 billion plus is possible, and a share price target in the mid to high teens is feasible. Assigning probabilities, I would weight the base case at 45%, the bear case at 30%, and the bull case at 25% given the current facts on funding and first patient enrollment. Those probabilities can and should be updated weekly as enrollment, safety data, and manufacturing updates arrive. Turning to Achieve Life Sciences snapshot and the factual base. Achieve shares trade around $4 to $5, and the market capitalization is in the roughly $200 to $250 million range. Crucially, Achieve has an accepted new drug application for cytisinicline for smoking cessation with an FDA PDUFA target date of June 20th, 2026, and the company has received an FDA Commissioner's National Priority Voucher and Breakthrough Therapy designation for a vaping cessation indication. Cash on hand as of June 30 is around $55 million, and quarterly operating expenses are in the low double-digit millions, which gives the company runway into or through pivotal activities and possibly through the PDUFA window depending on spending cadence and any additional financing moves. The business case is straightforward. If cytisinicline is approved and obtains commercial uptake with reasonable reimbursement, the addressable market for smoking cessation and vaping cessation is large and recurring, with millions of potential patients. The regulatory milestones in hand materially de-risk the program relative to earlier stage biotech names. Now the numbers that matter for Achieve. As of the latest filings, cash and marketable securities were approximately $55 million. Trailing operating expenses run roughly $12 to $13 million per quarter, implying current cash supports somewhere between 4 and 6 quarters of run rate without additional fundraising, but pre-launch commercialization and litigation or advisory costs can accelerate cash needs. The PDUFA date provides a clear calendarable event with predictable timing. From a commercial modeling perspective, if cytisinicline secures approval and achieves conservative peak annual sales of $300 to $500 million in the United States alone, and if the company retains a reasonable gross margin and partners for commercialization, the enterprise could be worth multiple times the current market cap. For example, at $300 million in peak sales and a 4 times revenue multiple, the implied market cap is $1,200 million, implying a share price multiple versus today of roughly 5 times. If peak sales are $500 million and multiple expands to 6 times, implied market cap could be $3 billion or more, and that would imply an even larger multiple on today's price. Conversely, if the FDA asks for more data or requests post-approval commitments that materially delay launch, the stock can fall back to a fraction of current value. Valuation and scenario framework for Achieve. I propose 3 12-month price targets tied to probability-weighted outcomes. In the bear scenario, where the FDA delays approval or requires an additional trial, and where the company needs to raise cash under stress, price target is in the $2 to $4 range, assigned 30% probability. In the base scenario, where the PDUFA completes on June 20th, 2026, with approval and achieves gradual uptake with limited distribution partnerships and conservative payer access, price target is $12 to $15 with 45% probability. In the bull scenario, where approval is granted, the company signs a strong commercialization partner, payers adopt the therapy quickly, and vaping indication is advanced. Price target is $25 to $35 with 25% probability. Those ranges are broad because biotech commercialization outcomes vary widely, but they are anchored to realistic revenue and multiple assumptions and the current balance sheet. Comparative risk profile between the two names. Both are small cap, binary, milestone driven, and require active monitoring. Achieve is a later stage regulatory play with a calendarable PDUFA date, which reduces timing uncertainty. Its cash position and lower near-term burn provide better runway into that regulatory outcome. Anteris carries higher technical and manufacturing risk because it must both run a pivotal device trial and then scale manufacturing for an implanted biologic product, which is capital and execution intensive. On the other hand, if DurAVR shows differentiated durability, valuation upside can be extremely large because device adoption and pricing can scale quickly in structural heart markets. Now the trade plan and portfolio sizing I recommend. Treat both stocks as speculative satellite positions only. For most investors, that means a single name allocation of 1 to 3% of portfolio value. For aggressive traders who understand binary risk, you can allocate up to 5%, but only if you set strict stop levels and mental position limits as the news flow unfolds. For both names, use layered entry with limit orders across a 4 to 6 week window to average in case of volatility. Do not buy full allocation before key readouts. For Anteris, avoid taking full exposure until you see consistent enrollment progress and manufacturing milestones that match management guidance. For Achieve, consider a staged scale in that increases exposure after FDA interactions that confirm no major deficiencies, and maintain a hedge plan such as buying protective puts if available and cheap before the PDUFA window opens. Concrete monitoring checklist and triggers. For Anteris, watch weekly. Reported number of patients enrolled into Paradigm, any interim safety updates, regulatory approvals for trial sites such as Denmark or the EU sites, CMC manufacturing progress and the use of placement proceeds, and abnormal insider or block trades. Triggers to reduce position include a public safety alert, a material manufacturing failure, or an unexpected need for a dilutive capital raise outside of planned timelines. For Achieve, watch weekly, confirmation of any FDA meeting outcomes, formal communications around the NDA review including any CRL signals, cash burn and plan for commercialization spend, reported progress on the ORCAV2 vaping phase 3 if applicable, and any partner discussions. Triggers to reduce include an FDA request for additional randomized data, a sudden sharp increase in cash burn without clear financing, or negative safety signals. Finally, let me give you my concise probability-weighted target for each name as of today to turn all this into one set of easy-to-use numbers. For Anteris, I place a 12-month price band of bear $2 to $3, base $8 to $10, bull $15 to $20, with my single blended target at about $9 per share, assuming present facts and a 45% base case probability. For Achieve, I place a 12-month band of bear $2 to $4, base $12 to $15, bull $25 to $35, with my blended target roughly $14 per share given the accepted NDA and the PDUFA timeline. Remember, these are scenario-driven, not model-perfect, and will shift as new cash, enrollment, or regulatory facts appear. To summarize my position and actions, both Anteris and Achieve are strong buy in my view for a speculative sleeve because each has calendarable or near-term milestones that can materially re-rate the stocks, but both require disciplined position sizing, weekly monitoring, and readiness to trim on dilution or adverse clinical or regulatory news. I am personally watching Anteris as a penny to microcap clinical milestone play and tracking Achieve for the PDUFA window. If you want, I will convert these scenario assumptions into a downloadable spreadsheet showing implied market caps, share price calculations, and probability-weighted expected values for each case so you can plug in your own probabilities and see how the fair value changes. I will also keep an event calendar and publish weekly flash updates on enrollment and FDA communications. That is my detailed, numbers-driven analysis on Anteris Technologies and Achieve Life Sciences as of October 30th, 2025. I am Simo from Investment Research, and I will be watching both of these closely and publishing immediate updates. You can just like the video if you, as gesture of goodwill, thanks, and that's all.